Welcome back to Talk Tickers. This is the show where we ignore the press releases, skip all the fluff, and go straight to the earnings call transcripts to figure out what actually happened to your portfolio.
And today we have a really interesting one.
We really do. We're looking at a company that honestly sounds like a cartoon character, but it puts up numbers that look like a typo.
It definitely has one of the more memorable tickers on the NASDAQ, that's for sure.
We are talking about Karooooo. That's ticker K-A-R-O. And yeah, if you're new to this name, it is spelled with 5 O's. But you cannot let the name fool you. We're reviewing their Q3 fiscal year 2026 earnings, and the market reaction was a bit of a psychological thriller.
It was. We saw a classic pop and fade.
So set the scene for us. The numbers drop, the opening bell rings, what happens?
Pure euphoria for a minute. Followed immediately by, well, anxiety. The stock gapped up. I think it's about 8% at the open, hitting around $48.34. The headlines were a beat. So the algorithms just loved it.
Really?
But then gravity and maybe some second guessing kicked in. By the time the closing bell rang, it had given back all of those gains and actually closed down over 3% at $43.34.
Yeah, that's an 11% swing in a single session. So the market is clearly conflicted here.
Completely.
On one hand, you have a company that's claiming they're in the top 1% of SaaS operators globally. And then on the other, you have traders just smashing the sell button.
Exactly. And to understand why, you really have to look past the headline revenue. You have to look at the cost of that revenue.
Okay, let's start with the good news before we get to the controversy. What did they post?
The top line is strong. I mean, really strong. Revenue hit 1.41 billion South African rand. That's up 22% year over year.
Okay.
But, you and I both know total revenue can be noisy.
Yeah.
The number that really matters here is subscription revenue.
The recurring cash, the good stuff.
Right. That was up 20% to 1.24 billion rand. And earnings per share, the bottom line was up 11% to 8.55 rand. So, I mean, double-digit growth basically everywhere.
So they beat the street on revenue and earnings.
They did.
Okay, so they beat the top line, they beat the bottom line, and they're growing at 20%. In a normal market, that stock should stay up 8%. But on this call, management kept throwing around a metric that I think confused some people, or at least made them skeptical. They called it the rule of 60.
The rule of 60, yeah, it's a bold claim.
It is. Usually we hear about the rule of 40 in software, right? If your growth rate plus your profit margin equals 40, you're an elite company. Karooooo is saying, forget 40, we're at 60.
And you know what? Mathematically, they are right. Their subscription revenue growth is 20%. Their adjusted EBITDA margin is 45%. You add those together, you get 65.
Hold on. Rule of 60 sounds great on a slide deck, but is this like real engineering or financial engineering? Because I can get to a rule of 60 if I just stop spending money or if I juice my growth by giving the product away. How are they getting there without cheating?
And that's the skeptical question you should ask.
Yeah.
But here's the thing. They aren't cutting R&D. They're actually generating cash. The 60 here comes from a very specific dynamic. It's almost a structural arbitrage.
Yeah.
They have a massive, mature business in South Africa that is, for all intents and purposes, a cash cow. It has huge margins because the infrastructure is already built out.
Right.
And they're using the cash from that cow to fund what is essentially a hypergrowth startup in Southeast Asia. So you get the margins of a utility company combined with the growth of a tech startup, all under one roof. That is how they get to 60.
So the South African business pays the bills and the Asian business prints the growth headlines.
That's it exactly. It's a hybrid engine. And that engine is accelerating.
That was the other keyword from the call, acceleration.
Yeah, 4 consecutive quarters of it. Their annual recurring revenue, their ARR, hit 5.1 billion rand. In US dollar terms, that is knocking on the door of $300 million.
What about subscribers?
A company record. They added over 111,000 net new subscribers in just one quarter.
111,000, that's a massive number. But are these just simple GPS trackers? Because if I'm just slapping a dot on a map, that feels like a commodity.
That's the misconception. This isn't just about where is my truck anymore. It's about what is happening inside my truck. And a huge driver of this growth is what they call the attach rate. They're selling AI-enabled cameras and these car track tags to existing customers.
Explain the tags. What are those?
It's asset tracking for everything else.
Yeah.
So if you have a construction company, you track the truck with the main GPS unit, but you also want to track the expensive generator in the back or the tool chest,
Ah, okay.
Karooooo is upselling these tags so the customer manages their entire inventory, all of it, on one screen.
So they are deepening the moat. Once I have sensors on my trucks, my drivers, and my tools, I'm never leaving.
Exactly. which is probably why their retention rate is sitting at about 95%.
Okay, so the growth engine is humming, but now we have to talk about the fade. Why did the stock drop? I was looking at the expense lines in the transcript, and one number just jumped out at me like a red flare.
I think I know which one you're talking about.
Sales and marketing expenses.
There.
Up 47%.
There it is.
I mean, stop right there. A 47% hike in marketing, that sets off alarm bells for me. Revenue grew 22%, but the cost to get that revenue grew 47%. If I'm an investor, I'm thinking, is the product losing traction? Do they have to shout twice as loud just to sell the same number of units? It looks like desperation, not growth.
And if you look at it in a vacuum, yes, it looks like just burning cash. It looks like margin compression. And that is exactly what spooked the traders who sold the stock off. But you have to look at the unit economics. This is where the LTV to CAC ratio comes in.
Lifetime value to customer acquisition cost?
Exactly. Management addressed this head on. They said their LTV to CAC is still over 9x.
Do you say 9x?
Over 9x.
Okay, usually in SaaS, people are high-fiving each other if they get 3x or 4x.
9x is almost unheard of at this kind of scale. It implies that for every dollar they spend on that quote-unquote expensive marketing team, they get $9 back over the life of that customer.
So if the machine prints $9 for every $1 you put in?
Then you are negligent if you don't increase spending by 47%. In fact, you should probably increase it by 100%. The CFO and the CEO, Zach Callisto, were very adamant about this. They see this spending as purchasing future cash flow at a deep discount.
So the market sees expense, but the CEO sees investment.
Exactly. It's that classic jam tomorrow problem. Investors see the margins compressed today because of the hiring spree, and they get nervous. Management is saying, relax, the profits will be huge later. But, in this market, people are very impatient for later.
So let's talk about where this money is going. We mentioned South Africa as the cash cow, but where are they hiring all these people?
They're hiring very aggressively in Southeast Asia and the Middle East. I think they're aiming for a 70% headcount increase in those regions for the year.
Wow.
And this brings up another nuanced point that probably dragged on the stock. The ARPU drag.
Average revenue per user.
Right. As they grow in places like the Philippines, Indonesia, Thailand, the revenue per user is lower than it is in their established markets like, say, Singapore or South Africa.
Which makes sense. Different economies, different price points.
Correct. But here's the problem from a reporting standpoint. When you add thousands of new users at a lower price point, it pulls down the average for the whole company.
So it looks like dilution. It looks like their pricing power is fading away.
Think of it this way. Imagine they're selling premium steaks in South Africa for $20. Now, they open a massive new chain of burger joints in Thailand selling burgers for $5.
Okay, so the average price of a meal for the whole company drops significantly.
Right. The average check size goes down, and the algorithms that just scrape that data hate that. They see the ARPU line pointing down. But what the algorithms miss is that they just sold 1 million burgers. They're capturing the market.
So it's a mix shift. The average drops, but the total pile of cash grows faster.
Precisely. It's a good problem to have, it's market capture, but it definitely confuses the headline metrics if you aren't paying close attention.
Speaking of confusing metrics, we have to touch on the currency. The South African rand.
The double-edged sword. The rand strengthened during the quarter.
Which sounds good for a South African company, right?
Well, yes and no. It keeps their local costs down, sure. But remember, they report their global numbers in rand. So when they earn money in euros or Asian currencies, and they translate that back into a stronger rand for the books, it looks like less money.
It's an optical illusion. The business is fine, but the translation makes the growth look smaller.
Exactly. It created a headwind on the reported growth rates from the international segment. You have to strip out that FX noise to really see the engine.
I want to pivot to management style for a second. We listen to hundreds of these calls. Most CEOs sound like they are reading a press release written by a committee of lawyers. Zach Callisto, the founder and CEO here, is different.
He is an owner-operator. He holds a massive stake in the company, and he absolutely speaks like it. He's direct, he's blunt, and he clearly doesn't care about Wall Street niceties.
There was a moment in the Q&A that I think explains the entire stock performance. An analyst asked about share buybacks. The stock is arguably cheap. They have cash. So why not buy back shares?
And Callisto basically just dismissed it. He said doing a buyback with their structure is very complex because of regulations. But then he dropped the bomb. He said, and I'm paraphrasing, if we have to go that route, we might as well just delist.
We might as well just delist. That is not something you usually hear a CEO say on a live microphone.
It shows his frustration. But it also highlights the liquidity discount that plagues this stock.
Unpack that a little bit for us. Why does the market ignore a rule of 60 company?
Because it's an orphan. It's a small cap tech stock, headquartered in South Africa, trading on the NASDAQ. The daily volume is tiny. I think it was about 78,000 shares on earnings day. That is a rounding error for big tech.
So the big mutual funds, the big pensions, they literally can't buy it. They can't build a position without moving the price themselves.
Exactly. And Callisto knows this. He's frustrated because he's running a Ferrari, but he's forced to drive it on this dirt road called low liquidity.
That explains the pop and fade perfectly.
It really does. When the liquidity is that low, the price is just naturally volatile. And when the CEO is openly ambivalent about even being public, it scares away the institutional money that provides stability. That delist comment wasn't just frustration. It was a warning flare that explains why the stock trades at such a discount.
But despite that frustration with the market, he seems incredibly confident in the business itself. There was that bit about the contracts.
36-month contracts, yeah. An analyst asked about enforceability. And Callisto, it essentially said that a piece of paper doesn't matter. He said, the contract goes in the bottom drawer.
The bottom drawer.
His point was, they don't enforce the contract. They enforce value. If a customer isn't happy, the contract is worthless anyway. They don't need to lock you in with lawyers because they lock you in with the product.
That is a flex. That is supreme confidence in your retention rate.
It is. And it aligns perfectly with that 95% retention number.
Okay, before we move on, just a quick check on the macro. Did the auto cycle impact them? New car sales are wobbly everywhere.
Management said they're basically decoupled from that. Their focus is on fleet efficiency. So, if a company isn't buying new trucks, they need to make their old trucks last longer. And that requires better maintenance tracking, better driver monitoring.
So if the economy is bad, you need Karooooo to save money. And if the economy is good, you need Karooooo to manage your growth.
They're largely cycle neutral. They track the asset, whether it's brand new or 10 years old.
Okay, we've covered the numbers, the spending scare, the burger versus steak dynamic, and the CEO who kind of hates the stock market. It's time to move to the segment that makes our legal team hold their breath.
I can hear them pacing in the hallway right now.
This is the part of the show where we have to say, this is not financial advice. We are not telling you to buy, sell, or hold anything. We're just two people reading transcripts and letting our imaginations run a little wild. We are going to pitch an outrageous but plausible trade idea based on what we heard.
All right, what's the play?
I call this trade pitch the Big Brother data arbitrage.
Ominous. I like it.
Here's the setup. We keep calling Karooooo a fleet management company. But that's boring. Management dropped a stat that blew my mind. They are generating 275 billion data points monthly.
That is a staggering amount of data.
And what are they doing with it? They're aggressively pushing AI video cameras into commercial fleets all across the developing world. We're talking face scanning, eye tracking AI inside the cab.
Okay, so they have eyes everywhere.
Exactly. They're building a real-time visual map of global logistics and driver behavior in the fastest-growing markets on Earth. Markets where insurance fraud is rampant, where theft is high, and where governments are getting increasingly interested in surveillance.
I see where you're going with this. You're betting on the panopticon.
The trade is a long volatility, short privacy pair trade. You go long K-Arrow, not as a telematics play, but as a proxy for the inevitable global mandate of AI surveillance in logistics.
So you pitch this to the investment committee not as we're buying a South African GPS tracker, but as we are buying the proprietary data set of the developing world's entire supply chain.
Exactly. Insurance companies would kill for that black box data to price risk. Governments would kill for it to monitor movement.
In the twist.
The twist is that the only thing growing faster than their subscriber count is the number of drivers realizing they are being watched by an AI that knows when they yawn or text or speed. It's the ultimate Big Brother arbitrage. If you believe privacy is dead, you buy Karooooo.
It's terrifying, but statistically, it's probably a winner.
The shift toward AI video compliance is undeniable.
Privacy goes down, stock goes up. It's cynical, but it's plausible.
And completely not financial advice.
Absolutely not. Do not do this.
Yeah.
But think about it.
All right, let's wrap this up. Recap for everyone listening.
Karooooo delivered a solid beat. Revenue up 22%, subscribers up, earnings up. All good.
But the market is hung up on that 47% increase in marketing spend. It looks like margin compression on the surface, but management insists it's a high ROI investment.
The stock popped 8%, then faded to red, mostly because of, well, low liquidity and confusion over the complex mix shift in their revenue. And remember that rule of 60. It's real, But it's driven by that structural split between the South African cash cow and the Asian growth engine.
And finally, pay attention to the CEO. He's building a business, not a stock chart. If you can't handle the volatility or the delist threats, this probably isn't the ride for you.
Before we go, I can't shake that 275 billion data point stat.
It sticks with you, doesn't it?
It does. We look at Karoooo as a stock, but maybe we should be looking at it as a preview of the future. I mean, if a trucking company in South Africa knows this much about its drivers, imagine what the rest of the tech stack knows about us.
Privacy is the price we pay for efficiency. Karooooos is just collecting the toll.
Something to chew on while you drive home.
Check your mirrors. We'll see you on the next deep dive.